Hi, this is Tai Hui, the Chief Market Strategist for JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what the investors are thinking about right now and how that impact on your portfolio. Now, this special podcast was recorded on 11th of March 2025, really as a result of the sharp market correction that we saw overnight. So in this podcast, I want to achieve a few things. One is obviously to explain what happened, why it happened, and of course, where do we go from here. So let's just run through some of the market reaction that we saw overnight in the US, and let's start with that. So if you look at S&P 500, the index, it was down 2.7%. It's down 8.5% since the peak in February. NASDAQ index was down 4%. If you look at US Treasury yields, 10-year was down 9 basis points, 2-year down 12 basis points. And you can see Asia morning, most of the markets are down sharply following what happened in the US overnight. Now, if you look at S&P 500, the composition, individual stocks, out of the 503 stocks in the index, 152 stocks actually went up. Most of these were defensives, utilities, materials, healthcare. 347 stocks were down, especially in technology and financials, and 4 stocks remains unchanged. Interestingly, as I mentioned earlier on, S&P 500 index was down 2.7%. But if you look at the S&P 500 equal weight index, which all 500 plus stocks have a similar or equal weight, that index was only down 1.4%. So it does reflect on the heavy skew towards technology, as the concentration of these companies really weighed on the index itself. So that's what happened with the markets, and let's explain why. I think the first thing, of course, is uncertainties from President Trump's policies, especially when it comes to tariffs, some of the cutback on government spending, and not so much the policies itself, but rather the way it's executed. If you look at, for example, the tariff against Mexico and Canadian exports to the US, the stop-start cycle, it does create a huge amount of uncertainties for the businesses who are exporting or importing from these countries. So overall, I think the concern here is that these policies are creating uncertainties for the businesses, for households, and that could dampen growth. And meanwhile, President Trump did mention that he's willing to take some hit on economic growth in order to achieve his agenda. So I think this contrasted with market expectations that President Trump really cared about the stock market, and it seems like his political or policy agenda is taking precedent. On top of that, the stock market was clearly pricing in perfection as we approach 2025 in terms of valuations, especially in the tech sector. So is there any good news that came through from the last 24 hours? I think a couple of things. Number one, US Treasuries, government bonds, it did exactly what it's supposed to do. It provided some cushioning, some protection against the volatility in the stock market. So, the 60-40 portfolio of stocks and bonds, while the correlation have not always worked as intended, at least yesterday as well as for the past few weeks, the bond market has reacted in line with what we expect to see during stock market volatility. And meanwhile, the overnight index swap market is now indicating a full percentage point cuts by the Fed by the end of the year. And remember, only a few weeks ago, the market was pricing in only 1 cut, maybe 2 this year, and many economists were calling for no change in 2025. So the recent weaker data on confidence and, of course, the market volatility could persuade the Fed to be a bit more flexible in terms of their policy making. And we will hear a lot more about this next week in the FOMC meeting. We still think the Fed's going to stay put with policy rates, but with the updated summary of economic projections, we may see a bit more thinking behind how the FOMC members are thinking in terms of growth and inflation outlook for the rest of 2025. And finally, there is a piece of news where President Xi and President Trump could be meeting in June. Interestingly, they're both born in June, they're both Gemini. June could well be a time that they could negotiate to de-escalate the trade tension that we've seen in the recent past. So I think, we do have some potentially good news in the market, But obviously, investors right now, they are trying to reprice the growth outlook in the US. So where do we go from here? Of course, market sentiment could remain cautious and volatile for the near term. That's what momentum is supposed to do. But at the same time, it's important to think about what are the possible relief the market could look forward to. The first one, I think, is coming back to President Trump. We still think that the market performance is high on his agenda, and therefore the current market correction could pressure him to be a little bit more tactful when it comes to policy implementation. His cabinet and also broader Republican Party may also put pressure on him to rethink some of his policies. Second point, as we mentioned earlier, the Fed may be looking to review its policy stance. While inflation and risk of it rebounding could still be high on the agenda, the downside risk to growth must be part of their consideration now, as we've seen softer sentiment data coming both from the household sector as well as the corporate sector, and therefore we could be going back to a more balanced, if not slightly dovish tone from Fed speakers in the coming months ahead. And also don't forget, there are some policies potentially could be supportive of corporate earnings, such as tax cuts and deregulations. I know President Trump's front-loaded a lot of bad news in the first 2 months of his term, but as the Congress start to debate on potential tax cuts and fiscal policies, that could potentially, again, be a positive factors for corporate earnings. Nonetheless, in terms of overall portfolio discussions and portfolio construction, diversification remains absolutely key. As we saw overnight, lower bond yields since February have helped to offset some of that equity market correction. And also, even within S&P 500, more defensive sectors and high-quality names have shown greater resilience. So that's very much a key call, or a key theme we've been advocating since the start of the year. We think that US tech has a very positive long-run potential, but in the near term, a broadening out of US allocation or US equity allocation continues to be key. And not just in terms of US equities. What about Europe and China? These two markets have been the outperformers of 2025 so far. We are releasing it on the minds of investors later this week on the National People's Congress meeting that just took place in China last week, and also another episode of podcast on European equities, so watch that space. But what you see here is both in Europe and in China, for different reasons, we may see more fiscal expansion. In Europe is to boost their defense in the context of the changing geopolitical landscape. In China, the ongoing weaker growth requires more fiscal stimulus, alongside with a potential upcycle in AI developments in China. So from that angle, I think a globally diversified allocation of equities continues to make a lot of sense. Finally, we have to re-emphasize the role of income. When equity markets or stock prices are being very volatile, consistent income, cash flow, income stream is always extra appreciated by investors. Now, this could come from the more traditional fixed income, or it could come from equity dividends, option premiums that, again, sacrificing some of the upside in equity markets, but providing some income via equity options premium, and of course, income from alternatives. These are all pretty good, decent sources of income generation. So again, if you look back to some of our recent episode podcasts, we discuss a lot of these tactics, especially in our last episode. We talked about transportation as a potential source of income generation. So thanks for listening. If you enjoy this podcast, please share this with your friends and colleagues, and also consider subscribing. If you have any topics that you want us to cover, please reach out to our JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in the next episode to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.